Hello, everyone. Welcome to Liquidity Narrative. So, in today, we are diving into one of the most important, powerful concepts for understanding how price really moves within a range. You know that price doesn't move randomly. Price is always looking out for something. And then we have what we know as our dealing range. Whenever we are trading, we are looking at that dealing range. But today we are looking at the internal range liquidity. The reason for the exam, the teaching, I'm going to make sure that I do it in a way that anybody can understand and use it to their own advantage. So the question is first, what is dealing range? Whenever we are talking about dealing range, now every teaching here depends on your own time frame. Everything that is being used here is an example of what to look out for or example in relation to what we are talking about. So first of all, when we talk about dealing range, what are we looking at? When we say dealing range, depending on the time frame here, we are using the daily time frame as you can see in the charts. We are using the most recent swing high and the most recent swing low, or the old as in the ones we can see. Those two becomes our dealing range, and we're going to make sure that this teaching will be a practical one, not just a talking section, a practical one. And I ask that after this, please go back, look into your chart, try it out, and see what you understand, and it will help you in your trading. So, first, before we talk about the internal range liquidity, which is the main reason for this, we have to define our framework using the dealing range. So, in this particular chart, we are looking at the swing high. You might ask, why am I not using the swing high? We can use the swing high, but we just want to use this because it's more visible to compare to Dix. Even if we use this, it's still okay. So looking at Dix, we are using this range as our swing high, and then using Dix low as our swing low. That becomes our daily range. So everything we are looking at, we are not looking at anything behind this area. We are looking at everything between this high and this low. So every other thing inside here becomes our internal range. So having said that, we've gotten our swing high, we've gotten our swing low. This is our dealing range. That means this is the range whereby we are looking out for trade. This is the range we are looking at to see what price action we do inside this range for us to be able to take a trade. So we have gotten the swing high, swing low. Then if we want to get um the half of this, that means the equilibrium part of this, we now have to maybe use our Fibonacci retracement. If we put it at the swing high to the swing low, we can use the body of the candles, or you can actually look at the wick if they are not too high. So having done this, we can see here is our equilibrium price. Let's mark that area, the half of it, using this. So we take off the fib. So this area becomes our equilibrium price. That is the 50% level. So the upside of this becomes the premier zone, while the downside becomes the discount zone. Now let's give an example. In every business, whether you are into a physical business whereby you make your buying and selling, or you're into a service rendering business, people wants to buy your service, or you want to buy a product when the price is low. That is discount. When price is discount, when you look at the shops, you can see people saying, oh, there is a discount of 10%, 20%, 30%, and that's when you want to buy that particular product. And the same at this in trading, we look out to buy when price it's or is favorable to buy as price get to the discount parts of the market. Whereby if you're selling a product, you want to sell the product when price is high so you can be able to make a profit. That is the premium level, which is this area. So we call this the upper part of it as a premium. That's the point we are looking at price to get to for us to start looking at for a sell within our dealing range. So the same is applicable in trading. So having said that, we've been able to define what our dealing range is. We've been able to define what the premium zone is, what the discount zone is, what the equilibrium, why this half, the 50% is known as the equilibrium. So this now brings us to the next stage of the reason for this. We are looking at the internal range liquidity or internal range liquidity. Yes, that's what we're looking at. Anything within this, whether it's the premium zone or the discount zone, becomes our internal range liquidity. Now, the question you're going to ask yourself, what is internal range liquidity? What are the things we are looking at in internal range liquidity? Because this is a higher time frame, like the daily time frame, like I said, you can use any time frame of your choice as a higher time frame. If you're scalping, you know the time frame you use as your major time frame, so you have to draw out your range within those areas. So because we've already mapped out our daily range, within this, we've gotten internal range liquidity. If we drop to the lower time frame, maybe from the 4H, 1 hour, 15 minutes, we'll see all these move has stuff has pullbacks and expansion within them. So let's go to maybe a lower time frame, starting from the 15-minute time frame within those ranges we've mapped out. So within those range we've mapped out, we've seen that price from this level, price has been doing this all these expansion, pullback, retracement, extension, and then consolidation within that within this range. That becomes that those are the internal range liquidity we are looking at. We can see that price pullback here, then expanded pullback here, expanded pullback here, expanded. That's how price will always be doing. All these areas are what we know or seen as internal range, and there are liquidities sitting within this internal range that price is moving from the up down. Price continue to move in those dealing range, which is our internal range. Liquidity are sitting down there. So what are the things we look at as liquidity that are sitting within that range or this daily range we've mapped out on our daily time frame? Remember, we mapped out daily range. We define the premium zone. We define the equilibrium. Then we define the discount. And then we said we are looking out for what we are looking at as internal range liquidity. What are those internal range liquidity? First, internal range, we can say there are those equal highs, those small minor highs, minor lows, equal highs, equal lows, the consolidation that are happening within this range. We can see price got to this place, consolidated as a in a little while, then dropped, makes a high, makes a low. Those are the areas liquidity are sitting. The X, we have the equal highs, we have the equal lows, the minor little highs, minor little lows, the consolidations, the fair value gap. Those are the areas that's inefficiency, imbalances, whichever name you named it. Those are the things that happen inside the dealing range. Those are the things that we can find in our dealing range. And that's where the smart money are looking at for the things or to place their order. So we need the internal range liquidity to aid us in our trading. So now you know we've defined that those highs, those lows, the equal highs, the equal lows, the imbalances, the fair value gaps, the inefficiency within our daily range. That's where internal range liquidity are. So the narrative is that the price is always looking for something within that internal range liquidities to grab a liquidity and then sets on its way to whichever part that the price has been going. But price needs liquidity to function. Let's look at it this way. The internal range liquidity is like a fuel, refueling your car or whatever thing you're using that needs an oil for it to work. Like if you're driving your car you know that at some point you need to refill yourself. So price always pull back to grab some flow, which are those liquidity. Liquidity sits on those areas within the internal range. That's why we call it internal range liquidity. Why the swing high, the swing low we mapped out on the higher time frame is known as the external range liquidity. So we have the external range liquidity on the high side and on the low side. Price, that's the main destination where price is going to. But price needs refilling, just like your car, just like your machines need to be refilled in order to function properly. Internal range liquidity fuels the main targets of smart monies to get to the external range liquidity. I hope that this explanation makes sense to you. So we need these things. So that's the reason, like I said, why internal range liquidity matters. Price always target those liquidity in order to refuel itself and then extend it. Let's say, for instance, now in this particular scenario, we've mapped out our um, external range liquidity. We've mapped out our dealing range. So as you can see, price dropped into this zone. Don't mind this area because we use it for the analysis we did previously, so I didn't want to take it out. Price dropped into this area. Then there was an expansion, a little pullback. Price came back inside this dealing range and filled this fair value gap. Then price moved up again and we had a little consolidation. Price came back, took out all these um, lows here, which can be equal lows here, then moved up a little bit, came back, drop back more. What is price seeking? All those liquidity within. It keeps coming back and then moving back a little while. Imagine that you joined this trade thinking that it has become a down trade and then suddenly price started to move up to the upside. Those are the liquidity. Is there anything here price is looking for? If you look back, you can figure out yes. So we have like a fair value gap here. We have another block, other blocks here. So price retraces inside them and continue to go on the main direction that it wants to go to. So this is like example of what we're talking about in the internal range liquidity. Then, sorry, let's move next. Let's move next. How will you use this internal range liquidity to aid your trading? That's the big question. Let's go back to our we can see what price was doing within those area. On this particular chart, you can see apparently you can declare that how price has moved down here and price started to go up. You can see what you have gotten here if you have used it the lower time frame on this particular chart. So the question now is how will you use this internal range liquidity to aid your trading? In order not to make this video low, we'll drop that in our next week. No, don't want to leave. Thank you. We'll drop that in our next week. Watch out for this teaching, the continuation of it on how to use internal range liquidity. I hope this stuff is helpful to you. And I hope you use it. You go to your chart, you look into it, figure out once what's your dealing range is in any time frame of your choice, and then map out those internal range liquidity and see how price returns into those levels. Once you understand internal range liquidity and external range liquidity, yes, you will stop chasing price and start anticipating where its price is next or where price is or what price is looking at for next to real to. That's how it is. Thank you so much for being here. Once again, it's your friend, the liquidity narrative structure over speculation. Take care.